high barriers to entry, excessive regulation, hostile government officialdom. But that's enough about the immigration line at JFK. We're here to talk this afternoon about frontier markets. And in a world where you've been hearing this afternoon where growth has slowed a bit, the BRICS are not exciting as they used to be, frontier markets are where many people think the next great excitement in investing will be. So let's start off, Sarah, with your wonderfully macro view of, where do you see the growth rate in frontier markets evolving? Are they still the exciting opportunities they were 4 or 5 years ago, or are they too slowing like the BRICS have slowed?
As a whole, frontier markets, we tend to think about Africa as encompassing most of it, which is true. But there are other areas, when you think of the Caribbean, when you think Sri Lanka, Vietnam, I would also put those into frontier land. But generally speaking, Africa, for sure, has a very good growth prospect ahead. Part of that is driven by commodities, and you can be fully convinced that the commodity super cycle is over. But for a country who goes from having no commodities to suddenly having some to sell, has a major impact on growth looking forward. Then we can talk about the demographics. That will lead to a significant increase in growth. And we're not talking 5 years, but probably the next 50 years. So from that perspective, I'm definitely most enthusiastic about frontier markets for long-term growth deliverance.
Now, you can think of them as sort of a high beta version of emerging markets, which are itself always seen as the high beta version of developed. Has that been how they've actually played out? I think some people here might be quite cynical that you get to the point in the cycle where you've invested in everything else and people say, aha, frontier's next. It's like, subprime securities. Or is it just a top of the cycle signal that there's an excitement about frontier markets, or have things genuinely changed and the underlying fundamentals are better than they were 20 years ago or 30 years ago?
So from the macro side of things have definitely changed. From the micro side of things, there's a lot of work to do. So taking a step back, about 20 years ago, I would say most of Africa fell into the non-investable category. So beta or no beta, you just couldn't even get access and you wouldn't trust your money in a lot of the frontier markets. You couldn't get it in or out. These days, you still have a hard time, I'd say, on liquidity terms. That hasn't changed. But in terms of its beta-ness, we're starting to see a differentiation going on because of the liquidity. So if you think about the emerging market sell-off that we've had this year, funnily enough, a lot of the frontier markets were much more insulated because those were longer-term investors who knew they weren't going to go in and out. And so if you were a fund that had to liquidate and meet redemptions, you didn't go to a place like Tanzania to pull your money out. You pulled it out of Brazil, where you could get it out quickly. So funnily enough, it's actually become less correlated with the typical risky markets, and by definition, the beta seems to be less relevant in this kind of period of investing.
Now, Eytan, you've been investing in these areas for quite some time. Just give us a description of what Vital does and what sort of things you look to invest in.
First, I'd like to answer another question that you asked, Sarah, and
you should be a politician.
Mo Ibrahim, quote Mo Ibrahim that said, "Don't tell the world about Africa, let us be there on our own and take advantage of the great growth that is going on there." So Vital Capital is an impact investment fund investing in Africa, sub-Saharan Africa. The frontier markets are driven by local issues, domestic issues, health, food, housing, agriculture. So if you want to succeed in those markets, you have to be on the ground. To be involved, you have to have your management there. It's not a passive investment. It's not just sending over the money and hoping that to get it out of there. You have to be there and be involved, know the culture, know the needs, and adapt your business attitude to every country and country. Each society is different. There are different languages. Even big countries are split to different regions. So the way to succeed is really to be involved. There are many obstacles, but it's getting much better. I'm involved for 30 years in Africa, and it's every year it gets better.
Now, how practically is that happening? Does it mean the regulations are reducing? Is it less corrupt? are minority. Are you generally a majority investor or a minority investor? Does the attitude of the parent company matter?
Yes, we insist to be either majority or have a management contract. We can have a minority, 40% stake, but at least have the management contract. Most of our businesses are in partnership with local entities, either government or private.
So it's a bit like China, is it, in that sense? You need to know the right person in the country, that if you're involved with the right person, then your money won't be taken away from you. Is that how it operates?
No. When you come as an investor, it's different than when you're a contractor for the government and then you have to get paid and have to influence people. When you come as an investor, like we do, you actually set your terms. We will do this investment provided ABC. We bring in our own values, and if they don't like our values, then we don't invest. It's much easier. So in the partnerships we have, even with governments, they participated pro rata in the equity, in the investment.
And are contracts generally honored? Have you had an experience of being nationalized or appropriated in any way, or have you?
During 30 years, I had never experienced default or any problem. Well, I can say that I lost more money in bankruptcy of banks in Europe and in the United States than in Africa. Yes. By the way, in Africa, how many banks went bankrupt? Do you know?
I don't.
0. So in the States, 400 or more, and in Europe, more than 100. In Africa, none. So your money would be safer there.
Sara, what's your impression on the governance standards when you're acting as an investor at Oppenheimer?
So we actually invest in debt securities in my fund, and so we look at the issuer from the context of mainly sovereigns, but some corporates in the more developed countries. In that context, Africa, for sure, I agree, is one that you have to do the due diligence on the ground. We haven't had bankruptcies or bank failures, mainly because there isn't a lot of leverage in the system. So it's an embryonic thing. It's almost like how many accidents, all the accidents occur when you don't wear your seatbelt. Well, they're all near your house where you're not wearing your seatbelt. It's like a spurious correlation. At the end of the day, we haven't had a lot of debt issued by African nations or the frontiers, and so obviously there's less bankruptcies and defaults. So in that context, we still find, I think what we're going to be looking at is 3 to 5 years from now, because of the QE globally and interest rates being very, very low, a lot of countries have come out for the first time and accessed capital markets, and a lot of companies as well. Some investors do a lot of due diligence. Some are just searching for yield in this yield-hungry world. What happens, I think, as liquidity starts tightening, we're going to find out which countries and which companies in these frontier markets actually can deliver the payments.
And some people thought the Rwanda issue was a kind of top of the market type
they
AOL
timed it really
warmer.
well.
What do you think?
Well, when Rwanda came out with that, I guess it was just under, it was a 500 basis point spread. Relative to everything else that was going on in the market, this was early May, so this is right about before the taper extravaganza that occurred. When we looked at that, and we're a longer term investor, we didn't think that was good value. So at the end of the day, we would look across the borders in Europe and say, okay, there are very highly rated banks who have a zip code problem of their own, who we can get a lot higher yield, and they're a trusted issuer who hasn't actually defaulted. Look at Rwanda, who actually has a great story. There's a really good economic story going on there, but that's not the right price. So right now, I think it's a very interesting time to investors that you have to look through the next 3 to 5 years and say, okay, where are interest rates going in the world? What's the right premium this kind of country or company is going to need to pay me to compensate for that risk?
Let's talk also about liquidity, Eytan. Yeah. You've got to get out. You've got into these investments. How easy is it to get out again if you're
liquidity is the biggest issue in Africa for sure. After just before logistics is a big thing, and infrastructures are required. But liquidity, if countries, if people have to pay 20-25% interest or in Malawi, 45% interest per year for loans, that makes it impossible to do things. So the way we deal with it, I'll give you an example. We deal with a trend of urbanization. There's a huge trend of urbanization now in Africa. 150, 200 million people are going to move in the next 10 years into cities. But today they're moving into slums. Someone has to deal with it. The countries cannot on their own. They need help. They need assistance, because World Bank, IMF, they all understand that proper housing is the best way to fight poverty, to reduce poverty. So we came into a country and discussed with the government of Angola, for example, and several others about this issue of new cities and housing, affordable housing, and started from the bottom. Okay, how much can a person pay in order to have a house? We reached the amount of a monthly payment. We built a price for the house, and from there we started building, engineering the cost. And there we forced the government, or persuaded them actually, that they must subsidize infrastructure. They must reduce the cost of the land and reach, at the end of the day, the price. We're building in Angola 40,000 units, out of which 15,000 were completed in less than 2 years and already sold, all of them. So, and now there come lots of additional issues. So, arranging the mortgage system. If the mortgage doesn't exist, then you have to set up the lease to purchase. Then you have the land registration issues that are in many countries. In Ghana, they're okay. In Mozambique, they're difficult. But you help the government as you go develop all these solutions for the different sectors. These new cities include everything: healthcare, education, full infrastructures.
And do you get involved in other infrastructure as well? I'm sure the British government needs quite a bit of infrastructure building. Perhaps you can pop over, but roads, sewers?
Everything.
Everything.
We cooperate with CDC. We're partners in a fund with CDC, IFC, and Africa Development Bank. And a new city is all about infrastructure. The house can be replaced, but the water treatment, sewage treatment, electricity, and public transportation, roads, recreation area are things you can't change. If you don't plan them from the start, you don't have it. And those are the things we take care of.
And from a portfolio investor's point of view, Sarah, how's liquidity in these markets?
Crappy is the easy word. So, for example, so there's a couple different asset classes. The stuff that Joyce was talking about a few minutes ago, dollar-denominated debt. You know, the issues are, I mean, it sounds like large numbers, 200 million, 300 million, 500 million, but in reality, very little gets traded. So on the margin, they're the least liquid of all the emerging markets, by definition. Local markets, which is, treasury securities issued in their local currency, there's only a handful of countries in the frontier markets that have the system set up that external investors can be involved. Nigeria is a big one. They actually made it into the big boy EM index, but some of the other ones, it's like a case by case, and it takes a while to get in, and it takes even longer to get out. And you can get out in good times, you cannot get out in bad times. So it really just illustrates the importance of doing your homework, and I completely agree. All these countries are different. I guess the recent wave of money into EM, a lot of dedicated emerging market guys are still, like us, are careful about doing the homework. There are others who are searching for yield, and it's going to be, Gabon and Ghana and Senegal and Zambia are all totally different, completely different macroeconomic policies, different liquidity and so forth. What we're going to be finding, I think, in the next 5 years is the differentiation comes there, and liquidity is going to, because it's illiquid, that'll exacerbate the problems when flows might be sensitive.
And is the problem that you could be extremely keen about all these markets, research them very well, and then when you put them into the portfolio, you've got a 2% exposure to frontier markets, which barely moves the dial.
Exactly. So if you're if you're a large fund, the amount of money and time that you have to put into the markets is quite substantial. You might get substantial returns on that, but if you count the man hours that you're putting in for due diligence, it might not move the dial that much. So it comes down to, I think, a lot of these markets tend to be dominated by dedicated frontier funds. We like to invest in them because it really provides a diversified portfolio for us, and we really love emerging markets, and that's our MO. But I think that for, say, crossover investors, different big funds in the U.S., these aren't made it into the center stage yet.
Great. Well, this is a big field. I understand we're trying to cover in half an hour, but if there's anybody who would like to ask a question, you've got the whole world to ask about, so hopefully there's something to ask about. Please raise your hand. There's a gentleman at the front here.
Hi, would you tier the frontier markets based on the commodities kind of super cycle that we were hearing about 2 years ago, and then everyone else after that in terms of consistency of returns, or is it more, it's a lot more complicated, I'm sure, than that?
It's fairly complicated. I'm sure you can add some more to it, but so for example, Ghana found oil several years ago, but it took several years in order to get the infrastructure, bring in the rigs, start getting it out of the ground, have a system in place, sovereign wealth fund type concept, and so forth, to actually get it moving. Now that's turned on. Angola is further along in the cycle of getting oil on, but again, we're talking the last decade, not the last 50 years. So when I think about the countries that are falling into the super cycle categories, the Brazil, Chile, Australia, and so forth, who've been kind of rode the big wave of the 10 years prior to 2008. The ones now, we have like Zambia and copper. Actually, literally almost every African country has something new coming online. In Nigeria's kind of aged in the cycle in terms of, but they've got lots and lots and lots of oil. So I still think that most of Africa's got that wave of hopefully getting it right and not losing the money a la corruption and so forth. But that can drive a spillover effect into bringing consumption online in the countries. So if that wealth is redistributed in a good way and saved for the right part of their cycles, think of the rise of the fastest, youngest populations suddenly have more wealth. They can go from, the typical path is like a multi-room dwelling with a dirt floor to concrete floors, then concrete floors to concrete floors with electricity. All of a sudden, they start demanding refrigerators. And this is all coming from the distribution of maybe commodity wealth. That can have a knock-on effect on growth and through a different kind of consumption channel and so forth that can be absolutely life-changing for the continent.
It's a young continent. The median age is very low. And these young people all have smartphones, and they have access to information much more than we had 20 years ago. They know what they want. They want to change. They want to do stuff. Things are changing. There are thousands of reasons to find that you can find not to invest in these countries. But there are very attractive reasons to invest. And to say the government is corrupt, so we won't put money in the population, is a wrong attitude. Because you can really deal with the local population, for example, in healthcare, in energy, and not get involved with the government. About the exit strategy, in our business plans, we don't calculate at all the terminal value of the businesses. All our IRR is built only on cash flow. So if and when we get to the final stage of the business, we will have probably some benefit.
One of those great risks, of course, people might worry about is the conflict risk. Nigeria has been mentioned already, where you have a long-running battle between the south and north. We've had Mali recently. We've had battles in Ivory Coast and so on. How do you sort of allow for that in your investment decisions? Is that getting better or worse over the years?
It's very hard to have predictability around that. And so, most of our investment analysis is about trying to establish playbooks on how the decision makers in the country or the incentives in the countries play out. And so in these kind of frontier markets, politics matters way more than in the countries that we were talking about with Joyce. Why is that? Because they don't have solid institutions that can carry through regardless of who's in power. where we do have that. In Brazil, we've had multiple changes and so forth. So when we look at our investment opportunities, if we find that if we feel that the country is unstable and we're not in it already, chances are we aren't going in it. Because at the end of the day, someone needs to write the check. That said, post-strife, post-conflicts can be the most amazing opportunities out there. In fact, one of our best returns ever was after Cote d'Ivoire, stopped paying for a while. It was just, they didn't have anybody to write the checks. They actually had the money, they have exports, they just had the conflict so that nobody was in the building to actually process bond payments and so forth. Now, it took a while to settle down and get a guy in who was allowed to write the
Sounds
check.
a bit like America, doesn't it?
Yeah, it does.
I was invested in Ivory Coast much before the conflict in a cellular operation. And during the conflict, the last thing they wanted to tear down was the cellular system. So it survived, and I was involved in Angola since '91. It was more than 10 years of war, and still the population need everything. They need agricultural development, they need cell phones, they need everything that is required for a proper life.
Another question from the floor, if there is one. No, well, let's just come back on Angola, because it's quite an interesting one, and you're getting that sort of post-colonization where Angola is now investing in Portugal and other places. Are you getting in those markets, and we know, of course, in the BRICS that you have global companies now that you can invest in, are you getting the kind of companies emerging out of Africa that people will say in the future it's the Lenovo or the Tata of Africa?
I think that the big businesses in Nigeria are very well known. In other places, Senegal and in Angola, world-class renowned oil company, and like you said, even conflict or not, I mean, they're actually pretty much the government. They have all the revenue source and so forth. So by joining forces with like Petrobras in Brazil, and they're on the cutting edge. And so I think it comes down to, and this is the case in governments too, for the companies who got too levered or too thin in places like periphery, in places like Europe, in some cases Australia and Brazil, they're ripe for the picking of these African countries who maybe by luck didn't have leverage, but they have massive cash and reserves and so forth. So I think that we're not quite there on a multiple industry basis, but there are definitely some select jewels that are going to be well known.
The way for that to succeed is partnerships.
Yes.
So there are huge African companies that will go internationally, and there are others that will need a partnership with international entities, companies. I see that happening, for example, in the chocolate, in the cocoa sector, where Mars is now changing the whole cocoa sector in Ivory Coast. They're thinking about doing the same in Ghana. These two countries provide over 70% of the cocoa in the world.
Well, that's a question that some people would regard these countries as commodity plays. So depending on your view of the commodity cycle, that's whether you should be investing in them. But is it, you were saying you're investing in infrastructure, so it's not just commodity plays for you, is it?
I mean, well, commodities are the ones that just because they have stuff that they sell in dollars that we can try to grab if they don't pay us, that's kind of a nice feature. But for longer term stuff, it's really the consumption-based companies that are the most attractive. Just the same way we looked at what drove, Brazilian resurgence and what's going to happen in China. I mean, that's going to be, I think, the next real big hotspot for all the frontier markets.
And Eytan, do you invest in the commodity area at all?
Not at commodity, but in processing. So in the agriculture sector, we do a lot of agriculture projects. Livestock, milk, eggs, others, and we do their processing, which is very important, all the processing sector. I think in the future there will be more, for example, oil refineries in Africa. Today most of the oil is refound outside of Africa. Then these huge oil producers have to import refined products. So it will change. There will be more and more skilled people to work in the industries and take part in the development of the countries.
And that's exactly what the government wants. You know, they want more employment. They see lots of young mouths to feed. In fact, I read the statistic yesterday that 1 out of 2 Africans are children. That's amazing. So think of that population coming and knowing that you just came through this period of like the unrest in North Africa, which is a lot to do with unemployment. You want to make sure there are jobs, and you want to make sure there's gas and oil, you know, to deliver to the cars for these people to get to their jobs. So I think that, you know, that would be a major effort for the governments in the next 10
And
years.
internationally, over 50% of the uncultivated land is in Africa, worldwide. So if we're thinking at food security, if we're thinking about solving international issues, you must invest in Africa. That's the place to be.
So final question. You've whetted the appetites of everybody here who've got their checkbooks just out now, and the pen is poised over them. There's one place to invest in, or one area to invest in. What would you pick?
I'd say, you know, in my universe, it'd have to be local currency Nigeria in the shorter term.
And what's the sort of yield on local currency in Nigeria?
Double digits, you know,
Yeah.
So, you know, anywhere from 10 to 15%, depending on the security. They're more liquid, so my comfort zone is more liquid products. Currency's pretty stable, so I think and it's not super correlated with the rest of the world.
Okay. Eytan?
I'd say the financial sector, I completely agree, is in huge need, insurance and banking, and obviously in vital capital.
Yes. We've got the plug-in at the end. Well, thank you very much.